Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin, Chief Currency Analyst with HYCM. I'd just like to ask you to type in the question panel as you're coming in, just so I can know if someone can let me know that you can hear me okay, so that I know it's all being received and understood. Let's just check. Yeah, Daniel, thank you very much. You're first off the mark. That's great. Thank you very much. Yeah, so welcome to this week. We're, really getting to an interesting point in the market, and there's a lot of big narratives in play. So I'm looking forward to, taking us through what we've sort of got coming up this week a little bit, as well as, understanding the context we're in. It's certainly a very interesting time in the markets, and there's potentially some volatility ahead. So it pays to spend a moment to really get our bearings to understand where we are. Okay, hi Daniel, thanks for letting me know you can hear me okay. Hi to David, Van, welcome back, Yasser, good to have you guys here. Just as folks are coming on, I'll just quickly go through this disclaimer. Just to make it clear that the whole idea of this website, this workshop, is to really inform you guys what to look for in terms of news impact that's going to move the market in a certain direction, what areas you should be looking out for. It's all designed to be sort of education. What it isn't designed to be is a signal service where, I give trade parameters and then you execute those trades on your accounts. Now, the whole idea of this is education. So you guys can see how a professional trader goes about making decisions. And the idea is that you learn from that decision-making process so that then you can make your own informed decisions and understand why the market moves in the direction it does. Now, obviously, there's caveats to that, and the markets are constantly moving. But over time, certain actions are predictable and repetitive, and just through practice, you begin to recognize and learn how to take advantage of those opportunities that come. So before we get going, just check that you have your handout. In the grey panel on the right hand side, you should see a handout panel, and in that handout panel there's a workshop guide. I'm just going to get rid of that last one there, and that should go, and I'm going to drag this week's one in there. So that workshop guide, May the 7th, should have just appeared now on your screens. Click on that and then you should have this website, this page up ahead. And for those of you who are regular and come each week, you'll know that I use this handout to be one side of A4 that you can put by your trading desk, and you can use it to get the context of the market, look forward to key events that are coming up, what you should be looking for, and then use it to choose your currency pair. So it's kind of a strategy to help you be informed and to know what the current sentiment is, what the fundamentals are doing, and then to choose your currency pairs on that basis. And of course, looking at our risk and then trying to review what's happened so we can learn from it in the future. So that's the whole idea of this workshop guide. Keep it up, print it out, use it, and this is the template for which we'll be looking at today, as per usual for the workshops. We try to keep it the same because we can learn when we do things in a repetitive way, and we can learn how to do it for ourselves. The special topic today at the end is understanding how to use the COT report. The COT report is just short for the Commitment of Traders report. And it's a report that comes out each week which tells the market where the big institutions, the large hedge funds are positioned, and whether they're long or short a particular currency. And I'm going to be showing you guys how to use that report, and it may not be what you're expecting. So that's worth hanging on to the end, so that when you see the COT report data coming out each Friday, it's released, you can understand how to use that to see the future direction of a currency. It can be a powerful tool when used correctly. Any suggestions you want for future topics, just email them to me here at giles.cochran@hycm.com, and I'll get hold of that message. And if there's any particular area of trading that you're struggling with, or maybe there's something you read, an analyst spoke about, and you're thinking, oh, I don't understand what that analyst was talking about, just email me any question that you have, and maybe we can look at that on the Tuesday workshop as a special topic, just like we're looking at the COT report today, how to use it. If you email a suggestion for a topic you'd like covered, then perhaps I can cover that when it comes to the next workshop, or certainly the coming workshops. It'd be great to have your suggestions coming through. Hi, Tribuvan, good to see you. Yeah, folks are coming in now. Hi, Yasser, good to have you back. That's good. Cameron, Ifam, welcome, particularly if you're new. Okay, so if you've just arrived, there's a few. Hi, Nadir, great to have you. Don't forget, guys, if you're new, you just come on today, don't forget the session handout can be found underneath the handouts tab on your GoToWebinar control panel. And when you open it, it should look like this. And you can print that out. And we're going to start looking at that now. And we're going to start by looking backwards. You can see here, I've just got a copy of that same printout here. So we start by looking backwards, and we've got a little bit of time to look back at. It's been a bank holiday weekend for me here in the UK. So I'm going to go back to the end of last week. And I really want us to go back to just get our heads around where the Federal Reserve is at the moment. Because on Wednesday of last week, we had the FOMC rate statement. It was unchanged as expected, but the market was expecting a more dovish tilt. The market was expecting the Federal Reserve to acknowledge that inflation had been soft, and thinking that because of that low inflation, that maybe the Federal Reserve would take a more dovish stance. That was what was being expected, and the US dollar was being sold on anticipation of a dovish Fed. However, when it came to it, the Federal Reserve wasn't as dovish as expected. Fed Powell, the chair of the Federal Reserve, said, you know, this low inflation is transitory. That was the phrase used. It's just transitory. We're expecting inflation to pick up. And so there was a pickup in the US dollar. However, on Friday, now Friday was a really tricky day to trade, and it's a good learning point, which doesn't help some of you guys if you were looking at the non-farm payroll data, because the non-farm payroll, and that's one of the most influential, data points out of the US. Less so recently, but still, nonetheless, it's a lot of attention. Is how many jobs are being added to the US market, and a good number here could have been seen as a positive for the US dollar, because it's confirming that the Fed was right to be slow to change to a dovish tilt, basically. So that number came out 263, which is excellent jobs result versus 190,000 expected. And the US dollar was bought on the immediate print. However, and this is where the learning point is, what you have to see, there was a quick reversal lower. Now, if you look at the data points, what you have to realize is that whenever you're reading the non-farm payroll data, it's a set of data. So in your mind, conceptually, don't just think of the headline. You know, at first you can look at that and think, okay, this is what matters, the headline figure. Is it positive or is it negative? And that alone is going to direct the US dollar. Actually, the non-farm payroll, I think, is going to help you guys much better if you think to yourself, no, hang on, this isn't one piece of data. This is 2 or 3 pieces of data that I need to correctly interpret. Okay, so I put it in bold to kind of show you the key data points that came out. Now, if you look here, you can see the unemployment rate is 3.6% versus 3.8% expected. So what that means is that's good, because the unemployment rate meant that less people are unemployed. Okay, it's only 3.6% versus 3.8% expected. However, the participation rate was down. And because the participation rate was down to 62.8% versus 63% prior, the data is given less significance. That unemployment rate is seen as less significance. And some commentators were suggesting that because of that low participation rate, that artificially increased, gave that unemployment rate of 3.6%. So in other words, it was a better reading because of the participation rate. And then these figures, this is a bit easier for you guys. These have been in focus more, certainly in the last sort of 18 months, 2 years at least. It's all about the average hourly earnings. If you think about it, it's not just about how many people in work, it's about how much they're earning. Okay, so the average hourly earnings, you want to see that going up, and that went down month on month, 0.2%. And it went down year on year, 3.2% year on year versus 3.3% expected. So we had a drop in the hourly earnings. So, okay, so even though we had an increase in the number of jobs, we had a drop here in the hourly earnings. So what that tells us is that it's a mixed data report. Okay, it wasn't clear. And unfortunately, this is what made Friday really difficult, was there was also some Federal Reserve speakers as well. We'll just have a quick look at the dollar yen for Friday. This is for our learning point, okay? Let's have a look. Where's dollar yen? Let me just call that up there. Right, let's have a look. Let's go back here and we'll look at Friday's data. Right, so there we go. That's there's the non-farm payrolls. That's the open that we had on Sunday. We'll cover that later, what's going on there. Now, if you look here, what you can see is that the dollar was bid and then sold off. Let's go down to the 15-minute chart and see if we can get a better look at this. There we go. So you can see that very large rejection candle here on the 15-minute chart, okay? So the dollar was bid and then sold off. So what was happening here is that, a couple of things. The market was digesting that data. And what the market considered was that, okay, although the headline figure is up, the detail is not so positive. Now, this was quite a complicated set of data points, but it's a really good one to help you guys realize when you're looking at the non-farm payroll, you want to be looking in at the data. So you want to be looking at the unemployment rate, and you want to see that as low as possible is positive. The average hourly earnings as high as possible is the positive.
Iran and the EU are reportedly close to a deal which would allow Iran to sell oil.
My apologies, I'm just going to turn that squawk off. There we go. So those are the information to really look at with a non-farm payroll. And then what was made even harder on Friday was we had a number of Federal Reserve speakers. Now, we had Fed's Clarida, who came out Friday, and he was saying does not see evidence of a looming recession at the moment. So he's keeping to the patient Fed line, that the Fed is being patient, wasn't concerned about a looming recession, and wants to keep looking at the economic incoming data. So that was Fed's Clarida. He was coming out and saying that on Friday. We had Fed's Bullard, James Bullard, and he was in an interview with Reuters. He was saying that he is open to a rate cut if inflation is still low after the summer. Okay, so this is important. So he's thinking a rate cut could be in order if inflation is still low after the summer. And it was low inflation going into the Federal Reserve meeting that was making people think that potentially the Fed could turn to a more dovish tilt. Didn't happen. And what the Fed had been saying is that the slowdown in inflation is temporary, it's transitory, it's passing. But Bullard says he's open to a rate cut if inflation is still low. So what that tells you is that the inflation data is going to be very important coming out of the US. And one of the things that we guys focus on is we want to focus on what the central bank is focusing on. Because when we focus on what the central bank is focusing on, we can see what's going to be moving the currency. And here Bullard is saying that if inflation is still low after the summer, he's open to a rate cut. And if the rate is cut, then the US dollar will fall. Okay, so this is the situation that we're looking at. He went through talking about the move in January when future rate cuts were taken off the table. The Fed went into patient mode, saying that low inflation and inflation expectations are concerning. Fed policy is a little tight. Fed should be careful. So he's a dovish member of the Federal Reserve, and he's just reiterating some of his concerns. Then we had Fed's Evans come out, and he says that there's risks of ease, but they're still larger than upside ones. So he said we shouldn't be too dismissive of core inflation drop. So Fed's Evans is saying, you know, he's concerned about that inflation. Some drop in inflation may be due to temporary factors, but he says sees risk, inflation expectations are too low. So in other words, he's concerned about the US inflation. So we know Bullard, we know Evans, both of them have mentioned that they're concerned about US inflation, and we know Clarida is keeping to the patient, looking at the next data points coming out. Just to reiterate, Jerome Powell said last week after the FOMC rate statement that low inflation was transitory, but some Fed officials saw a potential cut if inflation data moves lower. This has been what's been weighing on the US dollar. Okay, it's this concern that the Fed may be tilting to a more dovish position, and that tells us here, doesn't it? Watch out for the next US inflation report. So if we look for the next US inflation report, let me just have a little look. We can see now, looking ahead, we'll just go to Forex Factory. It's a nice, easy to use calendar that many people have access to, and we'll just look at this month. So this is how you look ahead in the data. You look at that month. So now all the data come up for this month, and let's just filter it out for the US dollar, and let's just have the key impact. And we can see that the next inflation CPI data is coming out Friday, May the 10th. Okay, so that's telling us, isn't it, that you know that okay, the forecast is 0.2% versus 0.1%, 0.4%. So in other words, there's plenty of concern here still for low inflation out of the US. Okay, so that's telling us that US inflation is a concern, something for us to register, and that is our moves, isn't it? That's what we want to be looking at. That's what we want to be considering. That's what we want to be focusing on in the upcoming weeks and months as we move ahead. So that is our focus that we've been able to discern from that coming up. Okay, over the weekend there was more trouble between US and China. Now, for a number of weeks, some very positive sounds have been being made about US and China. And last weekend, that came unstuck. And this was the tweet, if I remember correctly, which made it unstuck. Donald Trump, he came out and he said, for 10 months, China's been paying tariffs to the USA of 25% on $50 billion of high tech and 10% on $200 billion of other goods. These payments are partially responsible for our great economic results. The 10% will go up to 25% on Friday, $325 billion. So what President Trump is saying is that he intends to increase the 10% tariff on 200 billion worth of imported goods from China up to 25%. So the US-China trade talks have been going very well. They're now under a lot of tension. And for those of you who are just new, let me just show you why that tension is so great and why markets around the world are concerned about this. We had the Bank of Canada, Governor Polotz. He was talking about this, how it's very difficult to predict what the outcome will be if the trade talks between the US and China break down. We had EU's Juncker talking about the difficulty and the strain that the US-China trade negotiations are putting on their economy. We've had the US, not the US, we've had New Zealand and Australia talking about the concerns of global trade wars on their economy. And the reason global economies all around the world are concerned about this is because the US and China, it may sound obvious, but it's not for obvious for everyone. US and China make up 40% of the entire world's GDP, okay? So that's why all the markets are really focused. In this pie chart, you can see, this is the economy by GDP. 25% nearly of the world's GDP comes from the US, and 15% nearly comes from China. And this is data from February 2017. So this is a big market concern. There has been a lot of interest from Donald Trump to make it appear that the deal between the US and China is going to work well. As I've been saying for some time, it's quite difficult for the US and China to agree a trade deal that kind of works for both of them. These are two competing global powers, and in essence, this is a fight for global dominance. So they are really pitted against each other, the US and China, and they're really trying to get the upper hand over one another. So the idea of this being easily resolved is not going to be the case at all. And that's what happened with Donald Trump. He all of a sudden has responded to what he perceived a change in mood from China. And we had the US trade representative, Lighthizer. He was saying that the US tariffs in China will rise on Friday, and then this is what he says was the cause. He said that over the course of the last week, we've seen an erosion in commitments from China. Munchin says China moved away from language in the agreement that would have changed it substantially. China was basically backtracking their commitments, and over the last week or so, the Chinese pulled back, and that was what precipitated Trump's tweet. So that was a big concern. Now, for those of you guys who've been following this for a while, what would you have expect to happen when this information hit the markets? Which markets would you expect to see moving? Just type it in the questions. What currencies and what markets would you expect to move on this negative sentiment? If you just, you just came to your news, yeah, you would expect, that's right, Chirivan, you would expect to see some US dollar strength, okay? What else would you expect to see? Yes, you would expect to see some Australian dollar weakness. Yeah, that's it, because of the correlation. Australia's economy, 30% of Australia's GDP is made up from its deal with China, so we expect to see weakness in the Australian dollar. Excellent. What about some other risk-off currencies? Which ones would we expect to be bought? Which currencies would we expect to be bought in a risk-off environment? Perfect. Japanese yen, Swiss franc. Okay, so that's what we'd expect. So what we saw, the Chinese indices, the Hang Seng Index, fell strongly on the open. Here's the open, and it fell from 3,000 down to 2,900. You can see that opening gap. Price was attempting to fill that gap, sold off. We also saw the Nikkei 225 now. Okay, now here, the Nikkei was on holiday for like 10, 12 days. So this was the open of yesterday, the first time it's been open in like 10, 12 days. And you can see, look, the Nikkei was just selling off. This is the 4-hour candlestick, I think. It just sold off 4-hour, 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 just selling, selling, selling. We then had Australia, Japanese yen, So obviously we expect to see weak Australian dollar, strong Japanese yen. So Australian Japanese yen short would have made sense, and we saw that that price gapped down strongly, and then price has strengthened to fill the gap and is currently selling off as we speak from that gap. Now that large strong bullish candle was from the Reserve Bank of Australia's rate statement, so that muddied the waters a little bit with that pair going into that rate statement. But we'll cover that as well, so try and make sense of that. But that's right, well done guys. For those of you who got it, in a risk-off market, this is what we expect. Risk-off markets that depreciate and during risk-off time. So first of all, we've got the yen and the Swiss franc, they appreciate, and the US dollar. So these are, in times of safety, people buy the yen, in the times when people want a safe currency, they buy the yen, they buy the Swiss franc, they buy the US dollar. Currencies like the Australian dollar, New Zealand dollar, and Canadian dollar, the high beta, higher yielding currencies, they trend to fall in value, okay? And then the Nikkei falls in value as well in that risk-off environment. So there's a strong correlation between the Nikkei and the Japanese yen, which is why I always look at the Nikkei and the overnight index to get a handle for risk sentiment in the overnight session when I come to the European session in the morning. Okay, now Monday night, the big news we had, and this was an event I was really looking for, was the Reserve Bank of Australia leaving their rates unchanged at 1.5%. Now I saw a potential for the Reserve Bank of Australia to cut their interest rates, but they haven't. Okay, so they had their latest monetary policy decision. They see further capacity in the economy. March quarter inflation is lower than expected. So further improvement in the labour market is needed to meet inflation target. So already we can see inflation as a concern. Again, a bit of a theme, isn't it? And we see they want further improvement in the labour market. So labour market is a focus. Domestic uncertainty remains around household spending, falling house prices. Conditions remain soft in the housing market. They expect the economy to grow 2.75% in 2019 and 20, and they see underlying inflation at 1.75% in 2019 and 2% in 2020. That just seems ridiculously high predictions. They've got Australian dollar at the lower end of its narrow range. They see outlook for global economy as reasonable, but risks are tilted to the downside. That again is the references that we've been referring to. Next we have, so let me just, that's it. Now, I think one of the reasons they've left their rates unchanged is because in 2 weeks' time we've got some elections in Australia. So there is a big incentive for the Reserve Bank of Australia not to change interest rates. They want to keep things pretty steady and stable going into the elections. But I think, my opinion is that they are heading for a cut next month at this rate. So it could be next month when they cut. They have kept rates unchanged for something like the last 30 rate meetings. They've kept the rate unchanged at 1.50%. So they've been very steady and stable, but it looks like they're heading for a cut next month. Now, do look at these data releases yourself. So I've got the web page here, the data release. I'm just going to send it to all you guys. So I'm going to put this. There we go. Okay. Let's just check that goes there. I'm going to send this to all. Now, if you hit that web page, you should get this page up. And it should look like this. Okay. So if you put that into your browser, you should get this web page. Now, you can follow this easily. Just go to Reserve Bank of Australia. You can see on the opening page, look, latest news statement by Philip Lowe, Governor, Monetary Policy Decision. You can also go to the Monetary Policy tab. You just click on that and you get the decision. And get into the habit of reading through the decisions, because you'll get to know what the banks are focusing on. And helpfully, we can see, if you look at the end of the decision, you can see the board judged that it was appropriate to hold the stance of policy unchanged at this meeting. In doing so, it recognised that there was still spare capacity in the economy and that a further improvement in the labour market was likely to be needed for inflation to be consistent with the target. Given this assessment, the board will be paying close attention to developments in the labour market at its upcoming meeting. Right, again, okay. So it was the same last week. We saw that last month, rather, the Reserve Bank of Australia said that they're paying a lot of attention to the labour market. So based on that rate statement, we didn't get any change. There wasn't anything particularly easily tradable out of that rate statement. But what data point is now going to be of particular interest for us as traders? Which data point are we really going to be interested in? Okay. Okay, yes, sir. So which data point is going to be particularly interesting coming out of the Australian dollar? It's going to be exactly, well done, Nadir. It's going to be employment data, because the central bank tells us what they're focusing on, and the central bank have told us now out of Australia that labour data is going to be very important. So this means that they were paying close attention to developments in the labour market. So a strong labour market reading will mean that the Reserve Bank of Australia is more likely to stay on hold. A very weak labour market reading will mean that the Reserve Bank of Australia is more likely to cut interest rates. And if they're more likely to cut interest rates, then we're going to see a fall in the Australian dollar. So just go to the Forex Factory, and you just go you just go here and you click on Australian dollar. Let's have some top tier data. Plug it in. See, this month we've had the monetary policy statement. We've got another statement coming out Thursday. Look at that for more clues. And then we've got employment coming up Wednesday, May the 15th. So we can see the employment data on Wednesday, May the 15th is going to be particularly important. And we can see here we've already got an analyst working on that particular release, and you can see it's going to be an interesting release. So we now know, as traders looking ahead, that could potentially be a high conviction trading opportunity. Okay. Inflation is important as well with the Australian dollar, and we'll be looking at, let's just see what's coming up in June, July, cash rate, August. So you can just use this very easy, very handy information to have, and you can look at that. So great. So we've got 15th of this month. We've got another potentially high conviction trading opportunity. If it's a real weak employment figure, we know that the Australian dollar is going to likely sell off on the back of that with some force, because of the emphasis that the bank is giving to that data point. Okay, then we come to Tuesday morning. UK markets were open after the bank holiday. It was quiet here in the UK. Everyone was relaxing, spending time with family. There wasn't much going on. So the European markets, London opened first thing this morning, and a particular interest. There's some data points. There was Germany March factory orders. They were up 0.6% versus 1.4% month-on-month expected. Now this was a weak data point, but it's historical from the first quarter, and we know that Germany has been down on the first quarter anyway. So the German GDP data, that's what really has weighed on the euro in the last few weeks. So again, keep looking for German data, okay, particularly quarter two data, as the market is trying to see, well, is this German contraction, was it a one-off? Is it part of a wider problem? What's going on? So German factory orders, German manufacturing is under the particular spotlight of the market at the moment. And of course, the influence of Germany will be felt in the euro because Germany is the largest European country. So that's why often the euro is traded as you know, I want to say a proxy for the German currency, but it isn't a proxy because the German country does use the European Union. But I'm just saying it has a disproportionate, it has a not disproportionate, it has a large impact on the euro, the data that comes out of Germany, and the German data is in focus as we speak. Now, there was some quite bad news came out of the UK at the end of last week as well, and I'll just show you what happened. I've just got it here on my other screen. I'll show you. There was some local elections, and these local elections took place at the end of last week, and they basically portrayed a very poor outlook for the UK. Okay, now if now this is what happened. Okay, the Conservative government, which is the current government that's in power as a coalition with the Northern Ireland's DUP, they lost 1,334 seats, okay, in the councils. Now, this is local elections, so this isn't national, it's local, and it was a really bad result for Conservative and a really bad result for Labour. It was a Liberal Democrat Party, independent people, and the Green Party that gained votes. Conservative, UKIP, Labour lost votes. So what this really means is that the British electorate have got really fed up with how long the Conservative and, in a sense, the Labour government have been held responsible as well for delivering Brexit. So the pound rallied quite strongly on Friday, and I'll show you why. Let's just have a quick look at that, and let's find the pound. Here's the pound US dollar. We obviously had US dollar strength. The pound was rallying here on the Friday. Now, what was happening here was very simple. Essentially, it became apparent that with both Labour and Conservative doing so badly, the market began to think, well, hang on, this means that there's much more likely to be cross-party talks between Labour and Conservative. And that is what fueled that rally. And that's what the market's kind of assessing at the moment is, will the Conservative and the Labour Party be able to get a joint Brexit agreement to bring to Parliament? And these poor results were seen as making it as a potential. Okay. Now, there was some research done by a Professor Sir John Curtis, and he calculated how these local election results would translate across all of Britain. And basically, this was the results that he saw. He saw that if there was a general election, it will be a Labour Conservative tie with a large proportion in independent MPs as well as Liberal Democrats. So you can see there's a hunger within the UK. Look, independency, 25% of the entire national vote could go to independent candidates. So, you know, that tells me how disillusioned people are with the Labour or Conservative governments. And it's a, you know, very interesting political time here in the UK. And, you know, the Liberal Democrat, that's not particularly new because Britain always used to be like a three-party politic nation. You used to have the Labour Party, Conservative Party, and the Liberal Democrat. The Liberal Democrats have bumped off after the last general election. They tried to do a kind of a deal with the Conservative Party, and it backfired spectacularly for them. But it looks like they're back on the scene with 19% potential vote. Now, Labour would be more inclined to bring Britain back into the European Union. So there's a number of different outlooks from here. But the question now is at the moment, and this is the headline to look for a agreement between the Labour and the Conservative government on Brexit talks. And if we get that agreement, let's look at the pound technically, right? What we saw, technically speaking, we saw that descending triangle, okay? Then we saw price break out of the descending triangle, so that break and close, retest, sell off. That breakdown of that descending triangle has turned out to be a false technical break. We've now broken up above the top side resistance of the descending triangle, and we're heading back down. Okay, so this is really the line in the sand. Price is now at the 100, 200 exponential moving average, and it's at the underside of this, of the top side of this ascending triangle. Okay, so we're potential, if that's a potentially technical place for a long, is to enter here with price just below the 100, 200 exponential moving average. That would be a place to test the waters. Again, not trading advice, just education. But if you think that that bullish candle is based on optimism that there will be a talk done, this would be technically a place to enter long. Get below the 100, 200 exponential moving average on the 200 area. Then the next target is this area down here, 1.290. So that's what we're looking at with the pound. But the thing to look for, the headline is cross-party talks agreed, okay, between the Labour and the Conservative government. That will likely see the pound rally 1 or 2%. So that's what we're looking for here. So to come to the end of the European session, the US-China trade talks are set to dominate the US session. This is going to be the focus of the market, okay? So be very careful trading the yen at the moment. Realize what's going on, that the market is potentially in a risk-off situation, and the risk is market is very sensitive to risk. Look out for those news. And Thursday is going to be the key data, because talks are taking place between the US and China on Thursday, and the tariffs are due to hit on Friday. So you can see we're really getting to a real crux moment. So again, that's headlines to look out for going forward. The strongest currencies at the end of the European session, we had the Australian dollar was the strongest. Now, that was a relief that the Reserve Bank of Australia did not raise interest rates. So that was why that was the strongest. We've had the yen the strongest, obviously on the risk off sentiment. And then we had the New Zealand dollar was the weakest. We have New Zealand dollar. We have Reserve Bank of New Zealand meeting this evening. I think it's 4 a.m. GMT. We will cover that as we look ahead. We don't want to miss that opportunity. So looking forward, we want to now look. We've already looked back. We've seen the recent sentiment in the market. We've got the key market sentiment. We can see that we're potentially in a risk-off environment. Market is sensitive to risk. We can see that we are having some temporary Australian dollar strength on the back of the Reserve Bank of Australia. That's unlikely to last. We can see we've got some yen strength, dollar strength, Swiss franc strength. Now we're looking forward. Let's look at the most interesting upcoming data. And we've got the Reserve Bank of New Zealand rate meeting coming up. And that's three things that we've got coming up. We'll just look at let's have a look. So this is it. We have, I'll just turn this to GM. Let's just turn that to GMT. So keep it. So let's go back to the calendar. Right, there we go. We'll filter it. Just get rid of the Australian dollar. So this is British summertime. And so at 3 a.m., that's 4 a.m. GMT, we've got the official cash rate data coming out. Now that is, going to be highly, could be a lot of volatility coming up in New Zealand dollar. That is an event that if you can get to, it's worth getting to. Okay. Now the cash rate is expected to remain unchanged. That much we know. Okay. Now a number of market participants are saying that the New Zealand bank will start to introduce interest rate cuts. Okay, some of the data has been softer out of New Zealand, and the question the market is asking now is, when are those rate cuts going to happen? Some people think it could happen as soon as tonight. Other people think it could be August, or another one in November. So I've seen a number of different analysts. The forecast consensus is 1.7%, but there is a risk for a surprise here. Okay, and just to get you guys, make sure you're in the zone. If the official cash rate is cut, what will the New Zealand dollar do? Will it fall or will it rise? Chibivan, exactly. Exactly. If the Reserve Bank of New Zealand cuts the cash rate, the New Zealand dollar will fall. It'll fall sort of 80, 90 points on the release. And that's the level. It'll be a strong, hard fall. And that, yeah, that's it. Well done, Nadir. Well done, Ifam. Yeah. So if the bank does cut their cash rates, that's an example when, for me, I would look to enter an immediate New Zealand dollar short. That's not trading advice again. That's just saying that is what I'm looking at as a professional trader. So I'm looking for this event. We'll set my alarm. We'll get up to see if there is a move. If the cash rate stays the same, then the next focus will obviously be on the monetary policy statement. So in other words, what do they say? And sometimes what the bank says can be a big clue. So they might say, we've decided to keep rates as they are. However, we're looking at cutting interest rates next month or at the next meeting. That is the kind of thing that happens. And then, there's potential of the rate statement as well. There's a change now for the way that the Reserve Bank of New Zealand are making the decision. Normally, previously, the Reserve Bank of New Zealand was unusual, is that the governor made the decision. Just one governor, or he would make the rate decision, that was it. But now he's changed from a one-man does it all to a committee. And these are the new committee members you've got here. You can just screenshot this if you want. You've basically got 4 people within the bank. You see RBNZ, 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 RBNZ. These guys are all within the bank. And you've got 3 who are external to the bank. So you've got 3 people who are not part of the Reserve Bank of New Zealand. So that's the new committee, a total of 7. And decisions, they're reached by consensus. A vote will be held if needed, and minutes will be published. And their existing goal was to keep medium-term inflation between 1% and 3% and support maximum sustainable employment remain unchanged. So looking here, we can see this is the data that's coming out. GMT, 3 a.m., official cash rate, 1.75%. So we've also got an FOMC member, Qual, speaking now later on this afternoon. He's not expected to say much because he's like at that meeting is like a financial regulation meeting. So it's not particularly market moving. So it's not necessarily going to say anything market moving. And we've got Bank of England's Haldane speaking as well. I'm not sure what event he's speaking at, but I'm not expecting much move at all out of Haldane, given the focus of Brexit, and we kind of know where the pound is, and he's not going to have anything that's going to be particularly revolutionary to the market that the market hasn't heard. I expect, so that'd be very unlikely. But the old commentator's curse. As soon as you say something like that, the opposite happens. But to be fair, I'm not paying much attention to that at all. The big news, the big event for me is the New Zealand official cash rate and monetary policy statement. Looking at the charts, this is when we start to develop a bias for certain currencies. we can see that, you know, potentially we've got a bias for a long yen, a potential bias long US dollar, long Swiss franc, as long as the risk-off environment holds. We can potentially see a bias for a New Zealand dollar, depending on what happens later on. So that's how we want to pair up a weak currency with a strong currency. So on Monday, I was looking to short Australian dollar against Japanese yen. I just had a little look at the charts, and I could see that we had the Reserve Bank of Australia meeting expected to be dovish. We had Japanese yen strength. So I paired up the Australian dollar and the Japanese yen pair, and I was looking to short that pair. The Australian dollar Japanese yen pair is a really good pair for like risk on or risk off. So if the market's in a risk off environment, then you see the Australian Japanese yen fall, and vice versa in a risk on environment. So, you know, Australian dollar Japanese yen is a good pair to kind of have up your sleeve. Looking at your risk, obviously, never risk more than 1% in your account. That's the golden rule that I use. And on top of that, try not to use leverage. So use your trade size the same as your account size. So for example, if you have, you know, $100,000 US account, you trade one standard lot. That your trade size of 100,000 is the same as your account size of 100,000. If you have $10,000 US in your account, you use one mini lot, which is 0.10, 1/10 of a standard lot, 10,000 unit of currency with a 10,000 unit of currency bank account size. So let your trade size and match your account size does help you to be a lot less stressed when you're trading. And then finally, we'll be looking at using the Commitment of Traders report. Now, the Commitment of Traders report is a very handy report that comes out once a week on the Friday. And what the Commitment of Traders report does, sorry, I had a cough there. What the Commitment of Traders report does is it really tells the FX trader what the positions of the large hedge funds and the large institutional traders are doing. So we can literally know where the big and the serious money is. Now, some people have looked at this report and they've used it in a very simplistic way. Okay, so some people look at the report and say, oh, okay, look, the hedge funds are short 105,000 contracts of the euro. I'll short the euro, or like, oh, hang on, they're short 100,000 units of Japanese yen. Well, I'll short the Japanese yen. When used in that very simplistic way, there was some research done that I read and found that if you just copy what the institutional traders are doing, then your results are the results of this one study I saw were just basically break even over, like, I think about 10 years. So if you use the Commitment of Trader report like that, there doesn't seem to be a market edge. So the way I like to use the Commitment of Traders report is use it to inform yourself of where traders get caught out. Okay, so let's look at a good example here. And the good example here is Japanese yen. Okay, so we can see, look, that's a large bias Japanese yen short. Okay, now whether the market is thinking that Japan might be embarking on quantitative easing again, or, you know, they're going to start returning down, upping their QE program, and that devalues a currency. I'm not sure. It could well be. But what we do know is there's a large Japanese yen short. Now, if this US-China trade war gets worse, which it seems to, what are we going to see with that position? What are we going to see with all those institutional traders who are short? What will they be doing with their short positions if the US-China trade talks turn further sour? What will happen to their positions? Will they be opening more short positions, or will they be closing them? Let me know in the comments. What do you think they'll be doing? Will they be opening them or closing them? Yes, Aaron, they'll be closing their short positions and there'll be less short positions. So that will drive the Japanese yen up. Okay. Yeah, that's it. You've got it. Okay. So what this is telling us is the market is net short by 100,000 contracts on the Japanese yen. So if we get a fundamental catalyst that contradicts this position, we're going to see these positions unwinding. And if we can see them unwinding, we're going to see the Japanese yen strengthen. Okay, so this was Friday. So let's just have a little look. I can see, you see there, price is just finding support off that line. Remember that line I just pointed out? You can see price is finding support. You can see it was testing that 200, 100 exponential moving average. You can just see there's a little bit of support there on the pound US dollar pair. Okay, so you can see that's nearly perfect support there. That's what you expect on a first test of these areas. Okay, so we're getting distracted. Let's go back to the pound yen. Where are we? Let's look at pound yen. Yeah, there we go. So this was, that was the overnight candle on Sunday night. So here we saw the sell-off on Friday, okay? And then we had Trump's tweet over the weekend, and we gapped down US dollar Japanese yen. So this is the yen being bought. So those positions are being liquidated. We can see the yen being sold. Those short positions being closed, rather, as people going yen long, okay? So we can see that strong pressure is now in the market. We saw price gapped, and price filled the gap and is now testing back down to this area here, okay? So you can see the gap was sold, gap was filled, gap sold off, and now we're testing those lows. Number of different ways of playing this. You could have played it from the Fibonacci retracement point. You could have used that resistance point here, somewhere around this zone here would have been very good. With 50% down 50% of the last down move, and the overhead resistance, support term resistance would have been good intraday. But that's what you're looking for. You see, you're looking for a contradiction. You want the fundamental picture to contradict the commitment of traders picture. So let's take another fictitious example. So say, look, we know that the market is 105,000 contract euro short. Say all of a sudden the US-China trade deal gets sorted. Say then that Germany says we've had a whole, Germany says, oh, we've got loads of more orders coming in out of all the people who were concerned about Brexit, and they were concerned about US-China trade deal. All those are behind us now. We're going to be taking on, lots of extra work. All those euro shorts are going to unwind. Okay. So what we have to be aware of is read the commitment of traders report and then read them in light of the story. So go through each currency pair and go, okay, so the market's euro short, they're concerned about German manufacturing, etc., etc. Market's pound short 5,000, okay, what are they concerned about? The Japanese yen, hang on, that's a lot of contracts short, potentially, when people could be going long Japanese yen on the risk on environment. So that means Thursday becomes more of a focus. So that's the way you use the reports. Focus in, look at them like that, and the COT report will help you that way to see where the market is. Wouldn't it be helpful to know where big institutional hedge funds are trading? Well, yes, it would, and here's the answer. This is the information that's freely available for you each and every week. You can just find it on the internet. So there's a good tip, good tool for you guys. Don't forget, with HYCM, we do a number of webinars that are one-to-one with me. If you deposit $1,500, you get 1 hour session with me. And the idea of that session is I really like to help people. So I'll give you a little questionnaire. You'll fill in the questionnaire. Let me know which area of trading you need, and then we'll go into things in more detail. You can obviously speak to me, and I can speak to you, so it's more interactive. The pro is if you deposit $3,000, you get 1 hour with me and 1 hour trading follow-up review, and we help resolve personal trading queries. And the premium is $10,000. You get all that's there, but you get 2-hour coaching session and 1 week VIP support with my email. So you can tell me what trades you're looking at, those kind of things, and I can respond back to you. Okay, guys, that is the end of our hour together. Don't forget, next Monday, we'll be back again. And next Monday, we'll be looking at the upcoming week. Don't forget, New Zealand, big data coming out potentially tonight. Oh, good, Daniel. I'm glad you're finding that helpful, and it's so good to get like a good education. I remember when I was first learning FX, going back to a decade now, I didn't have anything like this. And the thing that HYCM is putting on here is really helpful, because you guys will just turbocharge your learning, and you'll see, what the market is focusing on, why currencies are moving in a certain direction. And once you spend a bit of time going over this information, it becomes second nature after a while. And the market just starts to make a lot more sense. So just keep up the learning, Daniel. It only gets easier the more you know. That uncertainty in the market dissipates. Don't get me wrong, the market can still do uncertain things, but you start to realize that uncertainty becomes less and less. Guys, I hope you have a great week. Don't forget, come back Monday next week, 12:30 GMT time. We'll have a little look at what's coming up, and we'll focus on the next coming events. Have a great week, guys. Cheers, Shubhavan, Yasser, Van, Daniel, Aaron. Good to see you guys. Take care. Be in touch. Bye.